Oil has slumped to its lowest level since the financial crisis, with the price of Brent nearing $40 a barrel. With me to discuss how OPEC has responded to the oil glut is David Sheppard, our Deputy Commodities Editor. So David, what happened last week?
Well, at the OPEC meeting last week, in the build-up to it, there was a lot of sound and fury and talk about whether there might be some way of preparing for a production cut, if not at this meeting, then possibly further down the line if we don't see the price recover. However, ultimately, the two sides within OPEC, one led by Saudi Arabia and the other arguably led by Iran and Iraq, just could not bridge that gap. As a result, the cartels meeting actually broke down with no decision whatsoever, and they actually did away with the pretense even of an output ceiling, leaving all members free to open the taps and produce as much as they like.
Is there any way to break the stalemate? Because Saudi Arabia has said that it will in no circumstance cut production alone, and only with participation from Iraq, Iran and other big non-OPEC producers such as Russia. So what's next?
Well, at this moment in time, the two sides look very, very far apart. However, what you could see, maybe not at the next meeting in 6 months, but possibly even further down the line, is that if this price continues to bob along at $40 a barrel or lower, that at some point you're going to have to see some reaction from the group as the pressure mounts. What we might see, because next year we have Iran coming back after years of sanctions, is we'll have better clarity around how much that country is actually going to be able to produce. If you get, say, another 1 million barrels a day of production in Iran, that's at the upper bounds of what they're predicting, then you could get more clarity at the next meeting, which starts to prepare the conversation around, right, we've got two big producers in Iran and Iraq on one side, both by that point arguably producing up to about 8 million barrels a day between them. That starts to compete with Saudi Arabia, who's producing around 10 million barrels a day. Could they then start to have a dialogue and look at production cuts between them?
We'll also have a bit more clarity on how non-OPEC production is sort of performing in the face of lower oil prices. But aren't they just sort of kicking the matter down the road? This is just a discussion they're going to have later on. Did they just, why did they put it off this time?
Well, this time around, there was just far too much tension between the two sides. Iran believes that it's coming back after years of Western-led sanctions linked to its nuclear program, and as a result has already lost a large share of its market. Therefore, it believes that it's unfair to ask it to cut production at this stage. Iraq feels similar after almost, well, more than a decade of war, sanctions and other problems in its country. Just now its production is recovering to a record level. It too thinks, why, after all these problems for so many years, should we be made to cut? But the problem they've got is that everyone continues to pump at the same level they are. Unless we see even stronger demand than we've already seen, and that's rebounded fast this year, we may be looking at a situation of lower for longer prices, which is the mantra which has taken hold in the oil industry. The other possibility is that we see the vast drop in the oil price really start to impact on non-OPEC production. We've already seen about 250 billion even or more investment come out of the oil market. At some point, you're bound to see that start to feed through into lower production from non-OPEC, which is expected to fall next year. And as a result, you might get the market start to tighten slightly. Of course, that depends on just how hard all the OPEC members pump.
So could we see $20 oil?
That's the prediction, or one of the scenarios that Goldman Sachs, one of the most influential banks in commodity markets, has come up with. At this stage, who knows? I mean, trying to predict the price is always a very difficult game, but you could see a scenario whereby if the market becomes truly flooded, that prices fall to that sort of level for a short period. Now, people aren't really predicting that as their core scenario at this moment in time, but with real oversupply in the market, it's possible for future prices to become unbound in the short term. However, $20 a barrel, at that point, you're going to start to see even projects which are profitable at $40 a barrel, some may start to shut in, and you'll probably see a very quick reaction that could bring prices back up. People are talking about what they call the so-called shale band. That's a level where the US shale output can withstand, say, down to about $40 a barrel, up to about 60, where more shale production can come on. If you fall outside either side of that band for too long, analysts and traders are expecting you'll get a very quick reaction in production and supply.
Thank you, David.
Thank you.